All right, good morning, everybody. Happy Wednesday. We'll get started in just a couple minutes. Okay. Good morning, everybody. Can you guys hear me okay? Just want to make sure the microphone's still working. Perfect. Okay, well, let's get started. Thanks for being here. I was out for a few days. I'm going to be in and out a little bit here, also with some client meetings and stuff. But we're back on track. This is our Set the Market morning call. If you're here for the first time, thanks for being here. Please make sure you subscribe to our channel. Obviously, that's free. Gets you updated on real time when we do our live analysis. And boy, do we have a market that is different than what we've seen for really years in terms of the rotation. I think most people have still not at all realized this. We are doing a state of the market later on today to update everyone on this again. If you want to tune in on that in a bit more detail. Also, as you're here, please make sure you give us a thumbs up like on the video. That allows us to be able to be picked up with the algorithms and allows us to be able to continue to do this show. So that would be awesome. So let's get started. The top few things on my notepad here today. We need to talk about the equity market in terms of the narrow breadth. I think that's unbelievably important. So we'll start there. Number two, the dollar. If you guys remember last week and the week before, we made a big deal that we thought the dollar could bounce. And that is absolutely happening now. So that's been a good call. I'm getting close to maybe closing that trade. Not there yet. Again, I was partially out for the past few days. So just trying to do a few more calls here with the street here this morning. And then I want to take a look at some other things that are acting really well again. We're looking at China, K-Web, options there, potentially uranium still acting very well. So let's kind of take it from the top. So one thing we need to be aware of as we start entering now the second half of July, and today's the 16th of July, so I guess officially the second half of the month. Look at this is yesterday's price action. If you look at the sectors, and I should move my picture a little bit. Actually, you can see it. If you just look at this part over here, I don't know if I can annotate this. Let me see. I know there's a way of doing that, but if you look at this here, this is the price action yesterday in terms of the sectors of the S&P 500, and you'll notice there's a lot more red than green. There was one sector yesterday that was green, and that was technology. Why was technology green? Because we live in a chart-chasing momentum market, and everyone's buying NVIDIA calls when you have things like, oh, we have a deal with China, and they can still sell their chips over there, yada, yada, yada. So people don't want to miss out on that, right? So technology is the only sector that was up yesterday. If it wouldn't have been an NVIDIA, the S&P would have been red right out of the gate, okay? So where does this leave us? I'm putting on hedges. I'm more or less maximum short in my personal account as a hedge equities. So I tend to hedge equities with futures. I'm at a more or less maximum short, hedge short, and I have been for about 4 days now on the S&P. That is not to say that I think the S&P is going to crash. For now, it's a hedge. So here is the confines within. I think the S&P continues to bubble higher, and it's these sort of rising wedges we keep talking about. So you have these rising wedge patterns, and they work until they don't. And it typically doesn't give you a whole lot of time to give you, to get out. So we had one, for example, that broke in December, which was a rising wedge that took about, let's say here, about August to December. Let's call that, let's call it 4 or 5 months. The latest one here has now been in development for April, May, and June, 3 months. So if this one was 4 months and this one was 3 months, we're getting really close. Again, I don't think the equity market's going to fall apart here, but can we get a 5 to 10% corrective move? That's garden variety. One should expect that every single trading day that begins, that is entirely possible through the lens of a few weeks. So if that were to happen, for example, when that happened in December, we first pretty quickly had about a 5% corrective move. Then we bubbled higher because the algos like to chase. And then ultimately, of course, that led to a corrective move to the tune of 20%. Now we have something very similar. And again, the 20% corrective move is I think more difficult to forecast. I think that would be fair to sort of quantify that. The 5 to 10% is garden variety, right? That's, again, any day we wake up, one should be able to expect that to happen. Again, we've had 15 years of a raging gambling market where that has not happened as much, which is typically why we're now probably going to go into a 5 to 10 year period where that is going to happen much more. But if we were to see this kind of a move, so yesterday, I'm not sure the intraday chart yesterday, but that would get us from yesterday's highs. Let's say we have a 5% corrective move, would get us down to about 600, a touch below. If it's 10%, that would actually fill an important up gap down to about 565. That would fill the up gap from the 12th of May. So those are kind of the two levels that I'm sort of circling here this morning. So let's look at this intraday, what happened yesterday a bit more specifically. This is the NASDAQ 100 yesterday. We gapped higher. Chart chasers beat chart chasers. This is the 5-minute chart. So this here is yesterday morning's up gap right there, right? And we essentially almost filled that entire gap. The S&P 500, which is a little less tech heavy, was actually down on the day, right? So if you were to look at the S&P 500 and you were to look at it here, you would notice that the S&P was 0.4%. If you only chart chased and looked at NVIDIA, of course, you wouldn't see that. But this is yesterday's price action. Again, we gapped higher in the morning. And then within the first, the first hour, we basically filled that entire gap and ended up closing at the absolute dead lows of the day. Okay? So what does that mean? Does that mean we now need to freak out and go short? No, but it does mean, in my view, that we have a very defined level up here, which is basically yesterday's highs. On the SPY, that's about 628. On the SPX, to give people, we have a global audience and people that don't just trade retail things like ETFs. 6,300, let's call it, or 630 on the SPY. That's your reference high. If we break above there, I would probably take my hedges off. I'm maximum short from a hedging perspective. I'm not like short the market. I'm just hedging. I'm basically flat equities right now. So if equities go down from here, I don't lose a penny. In fact, I could argue that if gamma squeezes, I would actually probably make money in the downside. But I typically start that way. So that's where we are in the equity market. Hope that's helpful for a bit of an update on that. Elsewhere, one trade I'm probably going to put on today personally is JP Morgan. I typically do a post-earnings trade. So I updated you guys on this for the past, I think about a week ago, maybe a week and a half ago. And I talked about JP Morgan once again being at the very upper end of a range or an upward sloping trend that it's been in since 2022. So that's not something new. That's been in place for some time. And can we overshoot? Of course, but we now had earnings. I'm probably going to look to put on some sort of an options bear call spread. I'll see you guys over in Trade Ops to lay out the details of that trade if and when I do one today. So that's going to happen over there. And then we really need to look at the dollar, right? So I quickly teased it before, but I talked about the dollar for the past couple of weeks. You guys remember me talking about the dollar? Do you guys remember me talking about that I thought DXY somewhere just north of 96 would be an entry point? I did. I mentioned that in real time all last week and the second half of the week before. And so I bought the dollar. Basically, I'm short the euro. This morning, the euro is just now breaking to fresh lows. That's literally just happened a second ago. I just got an alert, so I'm making more money right now on that short. But I'm looking to cover that in the not too distant future. Again, I don't have a specific time on that, but that to me was kind of an alpha trade that I wanted to have on because I was off for a few days. So I hedged all my equities and I went short the euro versus the dollar again a week and a half ago or something like that, and I still have that trade on. So that is also, yesterday the dollar had a big up day, and that's also why material stocks, so like the XLB ETF, was the worst performing sector yesterday. I think that's a buying opportunity. If you are an ETF Silo Pro member, we've got some trades coming up on this to take advantage of that, or at least around the peripheries. And of course, speaking of materials, we cannot ignore the extremely bullish movement that uranium is doing once again. So we had a major breakout move in uranium. It is once again flagging here right now. So uranium is essentially at a point where I think it could have another up leg. Now remember, uranium is very volatile, so we need to be mindful of the volatility of something like this. So, but I think these are interesting. So we've done a lot here over the past 15 minutes. Hopefully, this has been valuable for all of you guys that are here for free as well. We talked about JP Morgan. We talked about in detail the S&P and the QQQ. We talked about uranium, the dollar. And I'm just going to look at if there's a JP Morgan trade to do, I will be over in trade ops for all of you guys members, and also potentially do a trade in do something in KWeb, which looks really solid. So hopefully this has been helpful, folks. Have a good start to your trading day. Again, remember that this is no longer the same market that we've had for years before. The best way of looking at that, and there's very smart people that I respect that are completely ignoring this because they're blind. They're being blind, sort of blinded by a few shiny objects. Just realize that year to date, the Max 7 stocks that have lifted the S&P 500 for the past 10 to 15 years are now up 3.8%. That's great, but it's about butt naked last behind everything else, right, in terms of significant performance. So if you're chart chasing Max 7 because NVIDIA is bubbling higher, because Yang is walking around in crocodile leather, things and prancing around, that's great. Just realize that is probably no longer the story that's keeping the S&P and the NASDAQ afloat for the next number of years. It's already lagging. We've talked about this now since April of last year. So the leadership is changing, right? It still has a very big impact when machines buy NVIDIA, because it drags the whole NASDAQ higher, as you saw yesterday. But the breadth is so narrow. I mean, it takes not even, it takes like a squirrel's hiccup, right, for this market to correct 5 to 10%. That's not because I'm bearish. I'm very bullish on a lot of things, just not necessarily S&P right here, right now, because of the narrow breadth that we've been talking about. So hopefully that's helpful, folks. I'll see you guys over in Trade Ops. Please give us a thumbs up, please subscribe to the channel, and we'll see you guys over there. And we'll see you back here tomorrow morning on Thursday. Take care.